We just got a big batch of economic data. We're going to go through it. Jobless claims coming in a bit higher than expected. Housing starts and building permits, now they dropped. To talk more about the economy, I want to welcome Peter Earle, senior economist at the American Institute for Economic Research. Also, Brendan Duke joining the conversation, senior director for the economic policy at the Center for American Progress. He formerly served as senior policy advisor at the White House National Economic Council. Good morning to you both, gentlemen. Peter, I'll start with you. Your just initial reaction to this, both from a political standpoint and if you're sitting in the Federal Reserve this morning, Jay Powell, watching television, thinking to yourself, what am I going to have to do about this?
So in the jobless claims, in the initial claims, I thought they'd be a little higher, but I think we're starting to see the collision between the price effects of the slowing disinflation in the first few months of this year, the retail sales pullback we saw in Monday's numbers, and the settling in of widespread minimum wage hikes that took place in early 2024. You know, there's a growing body of data showing that businesses are trying to reduce labor costs. NFIB polls show that business optimism is at levels last seen in 2012, 2013. So it doesn't seem surprising that we're seeing some of this. You know, the cumulative minimum wage increases in New York were roughly 23%, California 20%, Florida over 30%, and you know, this is on top of the 15 to 20% increase in inflation over the last 3 years. So this is unfortunate, but not very surprising. You know, as for what the Fed's going to do, you know, several times in the past few months, Powell has said that unexpected weakness in labor could, just like continued disinflation, prompt a rate cut. I think that if we continue to see rising initial claims, and we have to put that in the context of the establishment and household reports we'll get later this month, we could see, you know, a cut on the basis of weakening employment later this summer, you know, absent what happens in disinflation.
Brendan, what's your initial take on all of this?
I disagree. I don't think there's that much to see here. These data are hard to read. I think the most basic test is really, do we have more UI claims this year than compared to last year, initial claims? We have 238,000 this week. We had 261,000 last year. So they actually went down. So I think that tells us what we need to know. We actually saw jobless claims rise over the same period last year. So it's really just, I think, residual seasonality. We saw the increase go away by July. That's what I'm expecting to see.
So, okay, so maybe nothing to see on the jobless claim side. I could understand that. What about the housing starts piece?
I'm not a housing expert, so not really my thing. I can't talk about the labor market, though, which is that, you know, the prime age employment rate in May was higher than it was in May of the previous year. So just according to the last jobs report, which I think is our best measure, really, you know, we're just seeing a strong, stable economy pushing forward.
Yeah, when it comes to housing,
Peter?
I mean, what I see.
Yeah.
When it comes to housing, what I see is, you know, I see inflation, high mortgage rates, rising unemployment, declining optimism. You know, more and more polls show that Americans don't think they could find another job if they left their current one. And, you know, so on the supply side, there's falling demand. Well, there's falling demand, and on the supply side, you know, there's a bit of pall over the industry owing to what we see in the cousin industry, which is, you know, commercial real estate. And nobody's going to shift from a 2 or 3% mortgage they got just after the pandemic into a 7% mortgage and take on another $3,000 a month to their monthly expenses. So it's not very surprising that we see housing starts and applications
Peter,
for permits falling.
That part I agree with you 100% on. The jobs piece, I don't disagree that there's anxiety out there, but there's a part of me that wants to agree with Brendan. If you just look on a historical basis at where we are in the jobs market, you would think that there should be euphoria.
So I will concede that this is a very noisy number, and this is a very noisy number at this time of year for a few reasons, right? We have teachers, you know, getting off. We have more gig jobs being taken. We have more summer employment. But I mean, you know, what I see is that companies are not reabsorbing layoffs and adding to headcount as quickly as they have for some time. You know, we see that in the and also in the quit survey, where a lot of workers think that they can't get a job as easily as the last one they had. These numbers, especially at this time of year, the weekly initial claims and weekly payroll numbers have to be put in the context of the numbers that we get in a few weeks, you know, 2 weeks, maybe something like that. The U3 numbers, the establishment household surveys. But yeah, I mean, I think that these numbers are noisy, and we have to put them in the context of what we're going to see soon.